Hey everybody, Rob Guy here with Tax and Investment Advisors with an important update. On July 4th, President Trump signed the One Big Beautiful Bill Act into law, enacting sweeping legislation that makes changes to everything from the debt ceiling to Medicaid to immigration to taxes. The new law is one of the most fiercely debated in recent memory, as politicians on both sides of the aisle argue about what it will mean for the economy, our national debt, and more. It also has many of my clients asking what it will mean for them. I decided to create this brief video to help you understand the new law and how it may affect your finances. Now, I'm not a politician, so in this message, I'm going to stay away from some of the more controversial aspects of the law and focus solely on the provisions that may have an impact on your financial planning. While some of it may not apply to you, it could apply to members of your family. If so, feel free to share this video with them. There's a lot to unpack here, so please take a few minutes to listen to this video. Most of these changes are fairly easy to understand, but if you have questions or concerns, let me know. Remember, my team and I are here to provide financial clarity. In my experience, that's one of the most important things any person can have. So let's cover some of the more important provisions of the One Big Beautiful Bill Act. Let's talk about changes to tax deductions and exemptions. During President Trump's first term, Congress passed the Tax Cuts and Job Act, which made major changes to the tax code. Many of those changes were set to expire at the end of this year, but the BBB has made them permanent. That means all current tax rates and brackets will continue for the foreseeable future. In addition, several deductions are set to increase under the BBB. For example, the standard deduction has been raised from $15,000 to $15,750 for single individual and from $30,000 to $31,500 for married couples filing jointly. Future increases will be indexed to inflation. For those who choose to itemize their deductions, the BBB also increases the state and local tax, often referred to as the SALT tax deduction. It's increasing that limit from $10,000 to $40,000. This deduction will increase by 1% each year until 2030, when the cap reverts back to $10,000. Note that the SALT deduction begins to phase out taxpayers earning $500,000 or more in annual income. There's one other deduction we need to talk about, but I'm going to save it for another section where I discuss how these changes may affect your Social Security benefits. Finally, the exemption on estate and gift taxes is also being raised from $15 million, up from $13.99 million for singles, and $30 million, up from $27.98 million for married couples. So, for all of you, when we get to that, $30 million number, we're going to have to redo your estate plan. Ha ha ha, right? But yeah, that's a pretty big number, 30 million for the estate tax exemption. Let's talk about some changes to tax credits. The BBB also makes some important changes to several types of tax credits, raising one while eliminating others. First up is the child tax credit. The current level of 2000 was set to expire by year's end, but now has been permanently increased to 2200. The original House version of the bill would have raised the credit to 2,500. So if you see that number anywhere, just know that that's out of date. On the other hand, the BBB nixes many of the green tax credits that consumers have grown used to in recent years. That includes credits for buying new and used electric vehicles or installing energy-efficient heating and cooling systems, including rooftop solar panels. The EV credits end on September 30th, 2025, while the latter ends after December 31st. So, if you are considering going green in any way this year, it might be best to do it sooner rather than later. Let's talk about those changes that could potentially affect Social Security taxes. The following information could technically have been covered in changes to tax deduction section, but as it's possibly the trickiest provision, I decided to address it separately. According to multiple media reports, shortly after President Trump signed the BBB into law, many of those receiving Social Security benefits received an email from the Social Security Administration. The email stated that the BBB would eliminate federal income taxes on Social Security benefits for most beneficiaries. You may have also seen this claim floating around on social media. As Social Security is such a key part of retirement planning, It's important to clarify that this is not entirely accurate. The BBB makes no direct changes to taxes on Social Security benefits. Instead, the law creates a new type of temporary tax deduction specifically for seniors. Individuals age 65 and older can now claim a $6,000 deduction if their annual income is $75,000 or less. Married couples filing jointly may claim up to $12,000 so long as their combined income is $150,000 or less. This deduction phases out above these limits, ending at $175,000 for individuals and $250,000 for couples. What does this all have to do with Social Security? Well, when coupled with other types of deductions, this provision can reduce taxable income for many retirees and pre-retirees. Given that Social Security taxes are dependent on a person's annual income, some retirees who take this deduction may find that, as a result, they no longer owe taxes on their benefits. If you're collecting Social Security, plan to start in the near future, or know somebody who is, keep in mind that it takes some careful number crunching to determine whether this new deduction will impact taxes on your benefits. Please let me know if you have any questions. Finally, bear in mind this new deduction isn't permanent. It's slated to expire after 2028. Let's talk about another provision regarding child savings accounts. For those planning to welcome a child or grandchild into the family over the next few years, the BBB contains a provision that's a new type of tax advantage savings account specifically for children born between 2025 through 2028. When opening the account, the government will make a one-time deposit of $1,000. Parents and relatives can each contribute up to $5,000 a year, and employers can also kick in $2,500. Any earnings are tax deferred until the child reaches 18. However, withdrawals at that time will be taxed as long-term capital gains. These types of accounts can be a handy way to help children save for the future, including higher education. However, there are a lot of rules regarding these accounts, and they may not always be the best option compared to other alternatives. And so for these reasons, let's chat before you or your family decide to open one. In conclusion, as you can see, the BBB comes with many changes that could have an impact on our financial planning. For most of our clients, the BBB should save them several $1,000s a year in taxes. For some people, many more than that. Of course, my team and I will continue poring over these provisions. If there's anything else we feel you need to know, we'll reach out or go over them with you during our next review. But in the meantime, don't hesitate to contact us with any questions.